Bitcoin has been called revolutionary, groundbreaking, and even the future of money. It has also been called a bubble, a fraud, and a giant speculative gamble. Warren Buffett, the legendary investor, falls firmly in the latter camp. Buffett famously called Bitcoin rat, poison squared, a statement that sent shockwaves through the crypto community and beyond. How could someone so revered for his financial acumen be so dismissive of what many believe is a transformative technology? The answer, as with most things in the world of finance, is complex and nuanced. To understand Buffett's skepticism, we need to delve into his investment philosophy, his understanding of value, and his views on the nature of speculation. Warren Buffett, often referred to as the Oracle of Omaha, is arguably the most successful investor of the 20th century. His company, Berkshire Hathaway, is a behemoth holding stakes in numerous blue-chip companies across various sectors. Buffett's investment strategy is rooted in value investing, a philosophy championed by his mentor, Benjamin Graham. This approach emphasizes identifying undervalued companies with strong fundamentals, holding them for the long term and ignoring the often irrational swings of the market. Bitcoin, with its extreme volatility, lack of tangible assets, and dependence on pure speculation, represents the antithesis of everything Buffett considers a sound investment. At the heart of Buffett's critique of Bitcoin lies a fundamental disagreement about the nature of value. Buffett believes that an asset's worth stems from its ability to generate future cash flow or possess inherent utility. Stocks, for example, represent ownership in companies that produce goods and services. Real estate provides shelter and can generate rental income. Bitcoin, in Buffett's view, does neither. He argues that Bitcoin is simply a digital token, a string of code that doesn't produce anything tangible. Its value, he contends, is entirely derived from the belief that someone else will be willing to pay more for it in the future, a classic definition of a speculative bubble. Section 4. A history of value investing versus the speculative frenzy. Buffett's investment philosophy is deeply rooted in historical context. He has always emphasized the importance of understanding the intrinsic value of a company, rather than getting swayed by market trends or speculative bubbles. This approach has not only made him one of the most successful investors of all time, but also a beacon of rationality in the often chaotic world of finance. He has witnessed countless market manias, from the dot-com bubble of the late 1990s, where tech stocks soared to astronomical heights only to crash spectacularly, leaving many investors in financial ruin, to the housing crisis of the late 2000s, which saw the collapse of the housing market and a global financial meltdown driven by reckless lending and speculative investments in real estate. In each of these instances, speculative fervor led to unsustainable asset price inflation and inevitable crashes. The allure of quick profits often blinds investors to the underlying risks, creating a cycle of boom and bust that can have devastating consequences. In each case, investors who bought into the hype at the peak often faced devastating losses when the bubble burst. The emotional roller coaster of seeing investments skyrocket and then plummet can be overwhelming, leading to panic, selling, and significant financial losses. Buffett, with his focus on intrinsic value and long-term perspective, weathered these storms and emerged stronger. His disciplined approach to investing, grounded in thorough research and a deep understanding of the businesses he invests in, has allowed him to avoid the pitfalls of speculative bubbles, further cementing his reputation as a voice of reason in often irrational markets. His ability to remain calm and rational in the face of market hysteria has earned him the respect and admiration of investors worldwide. Bitcoin, with its meteoric rise and subsequent crashes, exhibits many of the hallmarks of past speculative bubbles. The rapid price increases, followed by sharp declines, mirror the patterns seen in previous market manias, leading Buffett to believe that it too will eventually crumble. He has often warned against investing in assets that do not have intrinsic value, and his skepticism towards Bitcoin is rooted in his belief that it lacks the fundamental qualities of a sound investment. Section 5. Rat poison squared, Buffett's infamous verdict. Buffett's skepticism of Bitcoin reached its peak in 2018 when he famously labeled it rat poison squared. This wasn't the first time Buffett had expressed his doubts about cryptocurrencies, but this particular phrase captured the attention of both supporters and critics alike. It was a bold statement that encapsulated his long-standing concerns about the digital currency. This stark statement, delivered at Berkshire Hathaway's annual shareholder meeting, sent shockwaves through the financial world and solidified his position as a leading critic of cryptocurrencies. The annual meeting, often referred to as the Woodstock for capitalists, is a highly anticipated event where Buffett shares his wisdom and insights with thousands of shareholders. His words carry significant weight, and this particular verdict on Bitcoin was no exception. While some dismissed his comments as the out-of-touch ramblings of an aging investor, others saw it as a timely warning from a man who had seen countless financial fads come and go. Buffett's track record of successful investments and his cautious approach to new, unproven technologies lent credibility to his warning. His analogy of Bitcoin being rat poison squared was not just a colorful turn of phrase, it was a reflection of his deep-seated belief that Bitcoin and other cryptocurrencies were dangerous, speculative instruments that would ultimately lead investors down a path of financial ruin. Buffett's rat poison squared analogy was not just a colorful turn of phrase, it was a reflection of his deep-seated belief that Bitcoin and other cryptocurrencies were dangerous, speculative instruments that would ultimately lead investors down a path of financial ruin. He argued that these digital assets lacked intrinsic value and were driven purely by speculation. To Buffett, the meteoric rise in Bitcoin's price was reminiscent of past financial bubbles, such as the dot-com bubble of the late 1990s and the housing bubble of the mid-2000s. He warned that, like those bubbles, the cryptocurrency craze would eventually burst, leaving many investors with significant losses. Despite the backlash from cryptocurrency enthusiasts, Buffett remained steadfast in his views, continuing to caution against the risks associated with investing in digital currencies. Section 6, A Market Divided, Navigating the Uncertain Future. Despite Buffett's warnings, Bitcoin and the broader cryptocurrency market have continued to evolve. While price volatility remains a concern, the underlying technology, blockchain, has gained wider acceptance, with potential applications in various industries. This dichotomy has created a fascinating tension in the financial world. On one side are those like Buffett who believe that cryptocurrencies are a speculative bubble destined to burst. On the other side are those who view them as the future of money, decentralized, secure, and free from the control of governments and institutions. Only time will tell who is right. Section 7, What's Your Take? The Future of Money. Warren Buffett's views on Bitcoin offer a valuable lesson regardless of whether one agrees with his assessment or not. Buffett, a stalwart of traditional finance, has often expressed his skepticism about cryptocurrencies, calling them speculative and lacking intrinsic value. His perspective is rooted in decades of experience and a deep understanding of market fundamentals. While some may dismiss his views as outdated, they serve as a crucial reminder that not all that glitters is gold. In the world of investments, caution and due diligence are paramount. His skepticism reminds us that every investment, no matter how revolutionary or transformative it may seem, should be approached with a healthy dose of caution and a clear understanding of its underlying value proposition. This is especially true in the fast-paced world of cryptocurrencies, where market dynamics can shift rapidly and unpredictably. Investors must not only consider the potential for high returns, but also the risks involved, including regulatory changes, market volatility, and technological vulnerabilities. The future of money is being written right now, and cryptocurrencies are undoubtedly a part of that story. From Bitcoin to Ethereum and beyond, these digital assets are challenging traditional notions of value and exchange. They offer the promise of decentralized finance, where transactions are transparent, secure, and free from the control of central banks. However, this new frontier also comes with its own set of challenges, including scalability issues, environmental concerns, and the potential for misuse in illicit activities. Whether they will revolutionize finance or fade into obscurity remains to be seen. The debate is ongoing, with passionate arguments on both sides. Proponents argue that cryptocurrencies represent the future of money, offering greater financial inclusion and innovation. Critics, on the other hand, warn of bubbles and the lack of regulatory oversight. As with any emerging technology, the outcome is uncertain, and only time will tell how these digital currencies will integrate into the broader financial system. What's important is that we engage in informed discussions, weigh the risks and rewards carefully, and make our own decisions about how we want to participate in this rapidly evolving landscape. As individuals, we must educate ourselves, stay updated on market trends, and critically evaluate the information available. By doing so, we can navigate the complexities of the financial world with confidence and make choices that align with our personal goals and risk tolerance. The future of money is not just about technology, it's about making informed, thoughtful decisions that will shape our financial well-being for years to come.